Right, good morning. We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: China's first quarter GDP and monthly activity numbers set to provide a reality check on whether the economy has turned a corner.
Stocks across the region following Wall Street lower after hot U.S. retail sales numbers spark concern about stubborn inflation. Treasury yields hitting new 2024 highs.
And German Chancellor Olaf Scholz prepares to meet with President Xi Jinping later Tuesday, even as the EU launches a raft of trade investigations against China. All right, we're just about an hour away until that data dump out of China. That's certainly going to be front and center here as we break those numbers at the top of the hour, and whether we're going to see that this rebound in the economy has some sort of traction here in the first quarter. That's certainly one thing that we're watching very closely here. 4.8% is a consensus here today. Outside of what we're seeing right now is basically still those risk-off moves. You know, you hear what people are talking about higher for longer and the like. Obviously, we heard from John Williams overnight talking about he still wants to cut rates, but certainly that narrative seems to be pushed back more and more. In fact, I think traders aren't really pricing it quite in until as early as November, late as November now, for the next first cut. Bank of America is talking about December now as possibly when this rate cutting cycle can begin. So certainly that leads to a bit of a risk-off moves. U.S. futures are pretty much flat after we did break below that 5,100 level when it comes to the S&P overnight as well. And we're watching very closely those dollar moves once again. I think we're up for a fourth straight session, 5-month highs for the dollar. And we're watching, this is really certainly rolling some of the Asia equity benchmarks. You look at Japan, we're down 1.6%. Kospi's down 1.5%. The tech plays certainly have been hit very much overnight as well. Seems like we're feeling that here. Taiwan just coming online, also down by about 0.7%. And you continue to watch what goes on when it comes to those treasuries, right? That strong U.S. retail sales print. We almost touched that 5% for the U.S. 2-year yield. We've come off that a little bit now. We're at 4.92, stabilized a bit in the 10-year. Brent continues to see a slight bid here. Given all the Middle East sort of tensions here, we have heard from Israeli military officials saying that they still vow that they will retaliate on Iran. And we're watching very closely what goes on with China, right? So right now we're kind of in this holding pattern before the big data dump, but everything from the consumption side of things, industrial production, are we going to see a more relatively slower start to the year? That's according to what Bloomberg Economics suggests here. NASDAQ Golden Dragon did this, not a whole lot to really in terms of conviction. And you take a look at really what happened yesterday. It was that divergence between the onshore and offshore, with the CSI 300 coming back in a big way, snapping out of 7 days of losses. It was all this talk in that state council meeting about market supervision, capital market development. That has sent stocks flying yesterday. Will that continue? That certainly is one key thing here. UBS had a pretty interesting note saying this brings us back to 2004 to 2014, Dave, back when they brought in milestones like the Stock Connect. So maybe we could be seeing something similar along the pipeline there. Right now, futures slightly lower.
Yeah, there we go. Certainly a jam-packed session today. In fact, at the bottom of the hour, Xiaolin Chen will be joining us out of KraneShares to talk us through these markets. And the last time we actually had her on Bloomberg Television, the conversation revolved around some of the direct engagements they've had with Chinese officials and how to boost sentiment in this market. We'll unpack what her latest thoughts are on this market alongside the opening bell later on, and also alongside, I should also mention, Yvonne talked about economic data. New home prices are due out this hour, and we're looking at, so far going into this month, 9 straight months of month-on-month declines across new home prices across 70 cities. Right, other things happening today. We talked about Olaf Scholz, of course, in China. We should be at some point getting you more lines on out of Robin Lee of Baidu, of course, his AI conference. Remember Ernie Bots? We'll get the latest on him or it. What's the, anyway, okay, I won't get into that as well. And very, very quickly, we'll show you this later on. To Yvonne's point earlier, onshore trading volume, CSI 300, Shanghai Composite spiked to the highest level in 6 weeks rather, on Monday. So want to watch there. There we go.
Let's get to our news desk. Editor Jill Deesis now. She's with us ahead of this big data dump. What are you guys going to be watching out for the most?
Well, I think at this point, so far what we've seen this year, Yvonne, is it's really the story of a two-track economy. We've seen industrial output actually holding up pretty well through the first couple of months of the year. Export data, I think, has been a bit shaky recently. We saw a big surge in January, February, but then those numbers that we just got for March late last week, really not as strong. So I think any kind of comprehensive data that we get that indicates how well, again, the factories industrial sector is holding up will be really relevant for us right now. And then again, but for as much as well as factory output has really performed to the start of the year, consumption still remains a major drag on the economy. I really want to look at those retail sales figures to see if there's any kind of upward momentum there whatsoever. I'm not really sure that that's going to be the picture, especially because we saw consumer prices essentially stall in March. So a lot of concerns there about what that recovery looks like, and then obviously, ultimately, what it may mean for continued policy support in the months to come.
Yep. New home prices, to your point on consumer prices, are also due out this hour.
Yes, and I think at this point we're still looking for that ongoing negative trend month on month for new home prices. I mean, look, we're also looking at I think the home prices on the secondary market as well, since that's a bigger market now. So really sort of changing the calculus a bit and what really matters there. But yes, I mean, look, the real estate crisis continues in China. I think we've continued to see various elements here showing us that we really haven't seen a comprehensive turnaround for the property market in China right now. What does that mean again for continued policy support? Not quite sure yet what it may ultimately take to kind of turn things around. But yes, I think we still haven't seen real estate really meaningfully turn a corner in China yet.
Not just yet. Jill, thank you. Jill Deese is there. Let's bring in the market angle here. Mark Cranfield is with us out of Singapore, our end life strategist. Mark, yesterday, CSI 300 up 2%, moving against the grain. There's weakness coming through global equity markets this Tuesday. Can we expect China to continue doing the opposite?
Well, you were talking about divergence there, which we saw between CSI 300, for example, and 8 shares in Hong Kong. There was another divergence onshore in China as well, which is probably a bit more worrying. So you had the CSI 300 up 2%, but the CSI 1000, which represents the small cap stocks, it dropped by 1% yesterday. So quite a big divergence between onshore indices. Now, the main reason for that was this news about the new regulations which are likely to come in from the State Council, because the threat there is there could be more delisting of China stocks going ahead. They've seen it before. It's happened where they delisted a few companies. This time round, there could be a lot more because the number of IPOs over the last few years has been much larger. Now, that obviously impacts the small cap indices a lot more than it does the big ones. There was also some suggestions that ETFs were being bought aggressively yesterday to help make the big cap stocks look a little bit greener as well. Now, this can't go on for too long. Eventually, if investors are really nervous about the delistings and they're losing money on the small caps, it will feed into the big caps as well. So you can't have a divergence like that going on for very long. Investors will start to get nervous. Now, if today's data is not helpful, if we don't meet all the expectations, that could quickly turn around the sentiment that looked on the surface to be good yesterday. It might not last very long.
And that MLive Pulse survey that you guys conducted did show that it still seems like whether it's equities, whether it's the currency in China, there's still, people are still quite negative about it compared to even the yen or the rupee. At this point, is it time to kind of go against that as well and be a bit more contrarian?
Certainly, if you look at the way people seem to be skewed, they seem to have a preference. If we asked them which currency would rebound the quickest, whether it be the Indian rupee, Japanese yen or the Chinese yuan, and certainly the yuan came in third of the three. So on that basis, it looks as though people are rather underweight the yuan and they have low expectations. So certainly if you're a contrarian, you would look at that and you would suggest that if anything has a chance to catch up, it will be the Chinese currency. There was a similar readout for equities as well. Again, they put China at the bottom of the stack of those three countries as well. So yes, it would appear that people don't have high expectations, so it wouldn't be too difficult to beat that. But at the same time, you need a lot of things to come together. What you are seeing is a momentum in India and Japan, which just isn't there in China. And in the end, a lot of major investing decisions are made on where the money is flowing. So if you see money flowing into those large markets, that's a deterrent for you to put more money into somewhere else. So there needs to be some kind of a positive change. It could happen. It may happen in the next few months. But certainly there's a reason why people are skeptical on China's chances of rebounding.
Right, and Mark, before we even get to the point where, you know, we have the, I guess, the scope to pick within Asian FX, I mean, the dollar is giving us something to think about, right? 5-month highs on whether you're a dollar index or a Bloomberg dollar index fan. You know, your question of the day, of course, out of the MLive team is on the yen and whether 160 or before that is a level of intervention we need to watch. Just put this together for us. How strong is this dollar, and can this continue too, Mark?
Well, the dollar is a problem for everybody. There's not really much that anybody can do to fight that. There's no major central bank that would have really the wherewithal and the power to take on the US dollar when it's flattening everybody. Now, the Japanese authorities, within the G10 space especially, they're probably the only one who would be prepared to put together a huge amount of ammunition to try and turn it around. We saw that in 2022. The level of intervention there was absolutely massive, and it overwhelmed the foreign exchange market. But the other important factor was at the same time, Treasury yields were starting to decline. So they were getting a boost from the US side of the equation as well. Those falling yields helped to soften the US dollar. Japanese authorities came in and they supported the yen. This time around, it looks as though they're on their own because US yields keep on going higher. That's not helping anybody, especially Japan. So if the Japanese authorities do come in, they are very much taking on the foreign exchange market one-handed. There's going to be no support for now from falling US yields. And of course, it looks as though rate cuts are going to be delayed further in the United States. That doesn't help Japan either. So there may well be intervention before 160, but how successful it is might not be as good as 2022.
Mark, great stuff. Mark Cranfield there, our MLive strategist, joining us out of Singapore. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
All right, welcome back. Futures are, in fact, taking a further leg lower. We're now down 0.5%. So, you know what? This is something we normally see of magnitude. So we'll see what happens here. We should be getting the reference rate of the day out too. Yep, here we go. 710. 28 against the US dollar. I missed yesterday because I wasn't here, but this should be something of note. Was it?
I think it was around that.
It was around the same?
It was still sub 710, I believe.
Okay. Well, 710.28. The estimate 724.57. Ah, there we go. Let's leave this chart and give it a little bit. Oh, there we go. Check that out. Boom. So there, 720s. Oh no. PBOC weakening, the yuan fixing to 1-month low. The dollar on the back of the dollar index hitting a 4-5-month high. I knew this fix looked funny. And anyway, we'll stay on top of the story. 14 minutes from now, new home prices are out. And in 45 minutes, we'll be breaking you some backward-looking data, GDP numbers, plus, of course, monthly activity numbers coming through out of Beijing.
It was 709 still yesterday. So this is a bit of a weaker fix here, and certainly one that we're seeing. That's why that reaction, that spike up in dollar China. Let's focus a little bit more on the German Chancellor, Olaf Scholz. He's set to meet with Chinese President Xi Jinping later on today after warning officials to address overcapacity and treat foreign firms better. His comments echo criticisms delivered by the U.S. Treasury Secretary last week. Let's get to our German government reporter, Michael Nienaber. He's traveling with the Chancellor and joins us now from Beijing. Michael, just tell us a bit more about what Scholz said in his warning on overcapacity, and how does it compare with what we heard from Yellen last week?
Yes, Scholz arrived in China already on Sunday. It's one of his largest trips yet to a single country. He's accompanied by a huge business delegation. Germany being one of the most important trading partners of China in Europe and vice versa. China is the most important trading partner of Germany. So he's facing a delicate balancing act here, but during his stint in Shanghai yesterday, where we first talked to students at a university, and later also told reporters that he favors free and fair trade, which basically means, in his view, there shouldn't be any punitive tariffs. But then came to the crucial point, and he added, it's really important for the Europeans that that China takes serious the concerns about overcapacity, about dumping practices. And he even got more detailed. He complained about Chinese practices of not allowing European companies to participate in tenders. And he also mentioned concerns about violation of property rights. So it was quite a detailed warning to the Chinese that they finally need to take those concerns about fair trade more serious. Otherwise, Brussels might have to act.
Right. So, Michael, these comments were made in Shanghai, and of course, I believe you guys arrived in Beijing late last night. So effectively, that's the talk. What's the walk going to be? What do we know about these actual restrictions against China from the EU?
So, Brussels has currently launched a probe into unfair dumping practices of Chinese electronic vehicles. So the Europeans are looking into whether China is massively subsidizing the production of green tech. And as soon as summer, the European Commission might come to a conclusion. And a part of Olaf Scholz's mission here, when he first meets Chinese President Xi and later the Premier Li here in Beijing for key talks, one of the key aims is to explain those concerns to the Chinese and make clear to the Chinese side that China must actually act on those concerns now to avoid a deterioration in trade ties, which Scholz definitely doesn't want. But he also will make clear that it cannot continue like this, because the concern is that those dumping practices will actually destroy thousands, if not tens of thousands of manufacturing jobs in Europe.
Michael, thank you for a preview also of what's coming up today with the German Chancellor, Michael Nienaber, in Beijing for us, our government reporter. Just to recap, these big moves we're seeing right now in the FX markets and coming off a weak reference rate out of the PBOC north of the 710 handle, which we normally see below that. We're now trading closer to 728 on the offshore rates. So certainly one to expect is an adjustment in the onshore rate when things come online in about 10 minutes from now. We're also looking at some weakness across the currency against other key crosses as well. And of course, the PBOC weakening to 1 month after this dollar strength story you've seen.
A lot of mixed signals, yeah. I guess, after we did see a weaker fix just a few weeks ago, and then now here we are. We're watching, of course, those China proxies. Your futures looking like this in the pre-market in Hong Kong. Certainly, we are hoping to see maybe a little bit more rebound after the big sort of lashing that we saw in Hong Kong. Plenty more ahead. This is Bloomberg.
Right. Following the PBOC weakening, the reference rate to 1 month low, the currency is down against just about everyone in the neighborhood, as you can see there on your screens.
All right. Let's get back to why. I mean, you talk about the dollar moves and what we've been talking about in the Fed. Yeah. New York Fed President John Williams believes that the Fed will likely start cutting rates later on this year if inflation continues to gradually ease. Now, he also discussed resilience in consumer spending and the economy, an exclusive conversation with Bloomberg TV.
Consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So yes, it's part of that story. But I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think consumers are spending.
What's the thinking in your office and among your colleagues about, does this last, or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year, probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place, probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
That was the New York Fed President John Williams speaking exclusively with our colleague Michael McKee.
Right. Ahead of the opening bell, and it's not looking good across these markets. We're looking at losses beyond the 1% handle, 2% in some cases, like Japan, for example. Hang Seng 1.5% to the downside. Asia Pacific stocks on track for the worst day in 3 months. The open is next. This is the China Show.
Welcome back. You're watching the China Show. The price action just the last couple of minutes has actually been quite volatile. If you take a look at how stocks are doing here across the region, the currency, and it really started with that U.S. retail sales print, which really lifted the dollar yields as well. That's why you're seeing a 728 handle for dollar China, and the PBOC letting that currency go just a little bit, just given that dollar pressure. But yeah, the weakest fixing we've seen in a month, Dave.
It needed to come, right? We were having this conversation during the break. Certainly, given the adjustment we've seen, the dollar index, highest level in about 5 months or so. In a couple of seconds, we'll be getting the open. We'll be getting the initial pricing on the onshore yuan rate, and also new home prices coming out in a couple of seconds. In the meantime, though, it's not good to be long these markets. The dollar's a problem. It's a very big problem across these markets today. As you can see, some steep drops. As you can see, HS Tech Index, tech-heavy benchmarks like that one, like the TAIEX Index, like the Nikkei 225, for example, the Kospi Index, are all seeing substantial losses. In fact, at these levels, 16.3, 16.4, we should be opening below your 50-day moving average, which was actually up until yesterday, and we'll see how we close today. Did provide some decent support for the specific benchmark as well, amidst, of course, what's taking place. The NASDAQ index, worst 2 days, NASDAQ 100 to be more specific, worst 2 days since October of last year. Okay, we don't have the onshore rate just here. We've been looking, of course, at also the sell-off taking place on the CSI 300. My producers might be able to show us your onshore yuan rate on bottom of your screens. That should be coming out any time now. We'll get you that number in a moment. In the meantime, though, one thing to pay attention to here as we await new home prices, are volumes. So yesterday, CSI 300 and the Shanghai Composite, volumes in both actually spiked to the highest levels going back 6 weeks or so. So certainly worth noting and to track it very closely as we approach, of course, the thick of this session today. And as you can see, we're down about 14 points on the CSI 300. So I'll leave this here for now as we continue to unpack what's shaping up to be quite an eventful session across these markets.
It certainly is. And we just got those that home data that you mentioned here. And in terms of March, maybe you could call this slightly better news. New home prices, marginally speaking, we're talking about dropping 0.34% month on month. So that drop is slower than what we saw in February. Used home prices also see maybe a bigger drop of 0.5% or so from a month ago. That drop also slower than February, but we're still talking about, I think when it comes to new home prices, a 10th straight month where prices have been falling continuously here.
Yeah, not very good. The fundamental backdrop, and in 28 minutes from now we'll be getting the activity numbers coming through to simply confirm and give us a more holistic picture of where this recovery actually is. Let's bring in Xiaolin Chen, Head of International at KraneShares, joins us right now to talk us through these markets. Xiaolin Chen, as always, a pleasure to have you on the show. I wanted to get started, and we'll talk more about China-specific themes in a moment, but I'm wondering how you're thinking about the macro picture now. I know you're bullish in China, but can we be bullish in China with the U.S. just presenting just such a good alternative? Look at the U.S. dollar, for example, today.
Thank you for having me on your show, David. This is obviously China as a single market. Typically, traditionally, China is a high beta play to U.S. So at the end of the day, if U.S. doing well, China, in a normal circumstances, should also do relatively okay. In this year, this is the second year post the pandemic, or beginning of the second year post pandemic restriction completely removed in China. Where are we in China today? We have very rich liquidity. We have very pro-growth market policy in place. Again and again, the policymaker came out at any events you can recall in recent or the last year. It's always been, how can we help? How can we grow the consumer? How can we grow the clean technology, so on and so forth. Policy and money is in place. Valuation decade cheap. I know there's the flip side of the arguments there. And the good companies are buying their own stocks back. At this juncture, you have more opportunity to take from the upside than the oversold downside. But, obviously China will not decouple as an equity market to the U.S. equity market. At the end of the day, if all these in place with the intention to grow the economy doesn't come through, I think the Chinese policymaker have a lot more tools they put aside to use in the near term.
Yeah. It's interesting you mentioned that. I mean, yesterday we saw that with the onshore stocks, right, where they basically bucked the entire world in terms of outperformance. Does it again prove that maybe China can still be that diversifier amidst all this macro madness that we're seeing with the Fed, higher for longer and the like?
It's a great question, Yvonne. China stocks presents its uniqueness in terms of the business they focus on, the customer base they have uniquely isolated in some ways, just based in China. Those starboard names in China yesterday stood up nearly 2% positive in terms of performance. Those companies are focused exactly the sector we discussed, clean, semi-innovative technology, so on and so forth. If China just focused on its own of the 870 million people living in the city, it would be sufficient enough for the Chinese company to back on their foot. However, for long-term sustainable growth, they still need to internationalize their business. In terms of a diversification play for Chinese equity markets in the global portfolio, with where global investors owning the stocks, with where the flow we have been seeing in the last few months. By the way, February, we start to see global mandates, PM, portfolio managers, are actually starting to buying Chinese equity in February. Obviously, need to see March data confirmed shortly. But overall, I think this is present a bit of a fundamental attractiveness to portfolio managers globally to own this space.
And you're in constant contact with European investors specifically, and I'm wondering what China bull case arguments that you observe them starting to listen to that previously fell on deaf ears. In other words, what are they more convinced about now as it pertains to China, and what remain sort of non-starters for them as well here, Xiaolin Chen?
Great question, David. I think most important is the commitment from Chinese policymaker. It's an emerging country, policy matters the most. Obviously, we have, from last year March until now, it's 12 months in a row that they have seen repeat commitment from the top senior leadership in China, either now that the announced trading program, the liquidity, all these things, the announcement of the ultra long dated bonds, all these actions. European investors perceive that as consistency and persistency announcements by the Chinese policymaker in terms of supporting the economy. That's number one. And they see the attractiveness side of the assets presence at this juncture. But the ongoing was a bit of a qualitative is one, to see if the consumer will pick up. They want to be wait and see and having a leg in, very small phasing in now, but wait and see mode. But it's more positive wait and see mode. Obviously, geopolitical issues also on their list to wait and see because of the largest, this is probably the largest election year in history for the big partners in China in terms of trading.
I'm sure you've been tracking all these flows, and I'm wondering what you've been seeing when it comes to these state funds buying ETFs. Yeah. I mean, how active have they been? And can this market still rally without that sort of support?
The support is more symbolic, in my opinion. Obviously, they announced 2 trillion, which is good. The market knows the money is there. Apparently, somewhere around 200 billion is already being put into place. They have a huge room to continue to do that if they chose to. I do think there's more legs to come than just this stabilizing fund of 2 trillion. Think about it, if CIC, China's pension, started buying this equity market, just like what Japan did. This can be a massive, influence from the national team into Chinese equity market. At this value, at this valuation, they got to see this asset class to be attractive to their own book, even with civilization in mind or not. The other things you got to be very mindful is the Chinese policymaker is trying very hard to produce a healthy financial market, a healthy financial framework in place. Yesterday, they announced 9 measures, all of that in goal to say we got to provide a very solid, stabilized, and basically create more values for shareholders by issuing more dividends, so on and so forth, which all the big tech firms are not doing.
Right, and my understanding is, correct me if I'm wrong, that you've actually sat with Chinese policymakers and officials, as they try and bring sentiment back into this market. What other pro-market measures you think are in store for investors here this year?
I think the policy team or policy makers in China, we did have a meeting with Chinese regulator in Beijing. The very first question, David, they asked me was, or asked our team was, how can we help the global investor? What is the sentiment? What do we need to do? I did make it very clear, very honest with the closed-door meeting is stay communicative, which they are doing now, which is very pleased to see, and be transparent. Why the policy is introduced, what's the purpose, why the reason is there. I think thus far, give the credit to the new leadership. They are doing exactly that. But I also want to say, don't overly done, because healthy or solid framework in place is good, but not overly done. I think they're not overly done. They are just correcting what is left over in the past. That's one. I think solid framework in one place. Consistency, please, to stay communicative, stay accommodative to the market, and start action. Put more liquidity into the market, supporting the corporate, which they are doing. Credits pick up in March, which is amazing to see that households started borrowing credits. Corporates also stepping in to borrow credits. Those are the actions, David and Yvonne, you want to see as a leading activity happening in China onshore.
Chen Xiaolin, and maybe no nasty surprises coming through, right? Chen Xiaolin, head of international, KraneShares live for us out of London. Thank you so much, by the way, for staying up or already being up this Tuesday. Right, so movers to tell you about 10 minutes into this cash market session. Times China is perhaps the biggest one to the downside here, receiving a winding up petition, I believe, from Hang Seng, filed by Hang Seng Bank. Shares are down by a quarter, which should be the biggest single-day drop going back at least 3 years or so. January 2022, the stock fell by 27%, so we're closing in on that specific day. But that being said, there we go, winding up petition there. A couple of other things. You have Chow Tai Fook. You have CATL earnings story. You had Sasa also earnings story on Friday. You had a big drop yesterday, a big drop further today. And some of these European or Chinese medical device makers are on the back of our reporting on potential or probes and investigations out of Europe. We're down 5.4% on one Shenzhen Mind Read, bottom of your screens. And also some changes as far as this watch list from Morgan Stanley. Top 2 are being added. Bottom 2 are being removed from the focus list out of the guys at Morgan Stanley. There we go. All right. Plenty more ahead, plus a preview of the monthly activity numbers, which are due out in about 19 minutes from now. Stay with us. You're watching The China Show. Happy Tuesday. If you're long these markets, either close your eyes now or forever hold your peace. Well, at least today. Asia Pacific on price, we're down 1.5%, so it's a bad day to be long these markets. And as you can see, some of these tech-heavy related benchmarks, TAIEX index for 1.4%, 1.8%, in fact. I guess this is what happens when the dollar strengthens and yields are at year-to-date highs.
Yep, but at least we have a standout here amongst the earnings picture, and we're watching CATL, of course, the battery maker. First quarter profit rose as the supply dominance in EV batteries really helped offset weakening overall car sales. Let's get to our Asia transport reporter, Danny Lee, joining us now with his takeaways.
Yeah, I think for CATL, and as we kind of forecast, if they could continue that profit momentum, it's a good sign compared to its peers struggling to maintain the momentum and are struggling as this wider, broader competition really ramps up. So CATL, as the market leader, really the standout for the last couple of quarters, beating expectations, and it earned CATL a price upgrade there from Morgan Stanley. So it's a pretty good across the board when it comes to keeping control of its costs. Got solid product mix as well. So pretty good looking into the future.
Is this a CATL story, or is this an industry story, or is it simply a CATL story because they're, as you point out, they're the leader in this space?
I think it's the CATL outperforming the rest of the industry, and given already how dominant it is, holding a 38% global market share, and compared to LG Energy, who is the second biggest player with only 13% you can see how far and away CATL has a tight grip on the market, and there's very few people who can shake it off. And you can see why maybe there are governments elsewhere concerned about the rise and the dominance of someone like CATL in a critical industry that the world is trying to wrap its head around.
Danny, thank you. Danny Lee, our Asia transport reporter. CATL up 0.6% amidst generally a sea of red out there. Looking at crypto, I'm just trying to look behind my camera for price. Yeah, here we go, 0.6% up on Bitcoin and also Ether. The big news, of course, yesterday here in Hong Kong, you have several asset managers now saying that Hong Kong has given them conditional approvals to start spot Bitcoin and Ether ETFs.
Yeah, let's bring in Rebecca Sin, our Bloomberg Intelligence ETF analyst, to talk us through. Okay, tell us who got approved to list spot Bitcoin and Ether ETFs in Hong Kong, and how significant is this?
So the 3 people that got approved are Bacera, China AMC, and Harvest. From a numbers perspective, Bacera has 6 ETF and 40 million in assets under management. China AMC has 15 ETF and 3.6 billion, so they are the largest of the 3. And Harvest has 3 ETF and 10 million in assets. So those 3 ETF issuers will be launching both Bitcoin and Ether ETFs. And the significance of this is ultimately Hong Kong's trying to be the virtual asset hub of Asia Pacific. And this gives them the advantage because ultimately they can now take Bitcoin or Ether and swap it into an ETF. So Hong Kong has positioned themselves slightly different to the US, where they're allowing in-kind creation and redemption. The US is only allowing cash redemption, and what this means is for someone who wants to purchase this in the US, they have to give cash to get the Bitcoin ETF. In Hong Kong, if you are a holder of Bitcoin or Ether, you can swap that coin into an ETF. And so slightly different mechanism. And so it's a historic moment, and this could be very important for Hong Kong because ultimately it will attract different types of players. So those already holding virtual assets can be interested in this ETF now.
And at this point, can we already have an early guesstimate on AUM, for example?
So in terms of AUM, we expect that this whole market could bring as much as $1 billion in assets under management to the Hong Kong market. To put into perspective, Hong Kong currently has $51 billion in assets under management. Hong Kong already has future-based Ether and Bitcoin. So CSOP and Samsung Asset Management have this, and they have roughly $200 million in assets in futures-based. So if each of these ETF issuers gather as much as $100 million in assets, we think that that'd be super successful, but we can expect as much as $1 billion in assets under management. And to replicate this, in the US, in terms of the Bitcoin ETF, it's roughly 1% of the market. And so Hong Kong is roughly 1% of the Hong Kong market would be equivalent to 500 million. So we think $1 billion is a pretty fair estimate.
What about demand? What are you looking at? And what sort of demand could we get from mainland China even too, Rebecca?
So that's one of the questions. A lot of people are like, is this product going to be added on ETF Connect? And our assessment is that initially no, because there's currently only 8 ETFs that are approved on the southbound of ETF Connect. But there is a $50,000 US remittance quota that people can use from mainland China. We were just in China last week in Shanghai, and we've seen that there's huge demand, but ultimately people would have to apply through the QD system for this, and it's unlikely that CSRC will approve this, at least for the time being, given that mainland China has a ban on virtual assets. But we do see there is demand, and so those in mainland China that are holding the physical Bitcoin or Ether could potentially swap this out, but it'll be interesting to see.
All right, Rebecca, thank you. Rebecca Sin there, our ETF analyst for Bloomberg Intelligence on, of course, Hong Kong, giving the nod when it comes to these Bitcoin Ether ETFs as well. You can get an insider's guide to the money and people shaking up the finance hub in our new Hong Kong edition newsletter out every Thursday. You can sign up through the website, bloomberg.com/newsletters. Watching very closely these currencies here this morning, just given the dollar, King Dollar is back in a big way. We're talking about that onshore rate still hovering at 724, but certainly we've been seeing this sort of catch down story with the renminbi, just given how the others have really underperformed of late, just given this dollar strength. So the PBOC letting loose a little bit that fix there to let that weakness go. And you're talking about now 730 could be that red line or line in the sand for the PBOC. Aussie dollar also seeing weakness this morning. This is Bloomberg.
We saw a bit of inventory accumulation in the first quarter, so you can't keep accumulating inventory quarter after quarter. There's a possibility inventory turns from a tailwind to a headwind in the second quarter. And also investors have been expressing some concern that now that the first quarter data are decent and in line with the government's target, perhaps the government would not feel as much urgency to continue increasing easing measures.
Wei Shan there, Goldman Sachs chief China economist, and talking a little bit more about why they also boosted their growth forecast for the year to 5%. And now we're just a few minutes away from that big data dump, and of course those first quarter GDP numbers as well. Retail sales, industrial output, investments, jobs, all that's on tap here. 4.8% is a consensus when it comes to GDP. Given just the weakness that we're seeing in the currency, I just got to wonder if we're going to see a bad number here today, Dave. Are we just going to see dollar China go rip higher?
Yeah, and might that also cause traders, and based on some of our reporting a few minutes back, the state banks are being asked now to sell dollars in the offshore market in case we do get that bad number.
Or we need some good data to help stop all this too, right?
And and hopefully we get that.
Yeah.
Hopefully we get that today. It's also we're in this sort of situation, it happens 4 times a year, of course, because of the GDP numbers, is do you focus on the GDP numbers or do you focus on the activity numbers, which will tend to give you changes month to month and the direction of travel in this economy? Estimates, as you can see on your screens. But when you look at markets, this really comes down to a dollar story out there. In fact, let's have a look at where we are market-wise, please. And we opened today at HSI, which is a very good example, opened below the 50-day moving average. Yeah. We were cheering to some extent us being able to close above 17,000 last week, but that's a last week story for now. And Asian markets are absolutely getting floored today by the strength coming through in the US dollar. Just about everywhere you look, in the equity markets specifically, pointing to losses here as well. I'd point to this, we have a story in the Bloomberg outlining this maybe out of consensus call out of UBS
About rates.
Rates, yeah.
Yes.
6.5%. The Fed hiking rates at 6.5% is a real risk, according to UBS.
The tail risk is what they're saying could be more real, right? Basically, sticky inflation, you have strong U.S. growth. That's really raising the chances that the Fed might actually hike rather than cut rates as well. So that's what they're saying in terms of 6.5%. The base case is still for 2 rate cuts this year to UBS. But there is this growing possibility that they don't think inflation is going to fall to target this year. No landing scenario, even they're saying, could lead to a sharp flattening of the U.S. Treasury curve, as well as they're talking about, in terms of equities, a decline of 10 to 15% too. So.
Okay, lots of conversations to tell you about on the back of that. So we'll be talking all things China with Moody's. But before that, the Vice Chair at BlackRock joins us to talk us through all things macro. This is the China Show.
Welcome back to the China Show. We're about a minute away from the release of China's activity data for March. Also, those first quarter GDP numbers, 4.8% is a consensus when it comes to growth in Q1. And certainly we're going to be seeing if there's answers any questions on whether the economy has turned a corner. We just had those new home prices and used home prices that came out about half an hour ago. The trend still remains the same, but at least these price declines have, I guess, moderated a little bit if you take a look at month on month. But certainly we're going to watch for more clues on what those other growth drivers are going to be in this Chinese economy.
And what the context will be as well from officials as they sort of take us through the context and the environment as well. So we should be getting that in literally 3 seconds from now. Forecasts were, generally speaking, for about 4.8% was the median. And wow, there we go. Okay, we are now out. Let me just bring up my screen. So we're getting a GDP. Should we start with GDP? Why not?
Yeah, 5.3%. That's a sizable beat from what the survey was suggesting there of a sub 5% print. So this is also seeing an improvement from the previous quarter. So 5.3%, that's a strong number. If you take a look at how the seasonally adjusted quarter-on-quarter number is looking, is also a beat, 1.6%. And we're watching these activity data, though, in March, maybe not looking as good, though, in March, Dave.
Almost the complete opposite of what the GDP print was telling us. Let me start with retail sales coming in at 3.1%. The median was, let's call it mid-4s, 4.5%. 5.4%, in fact, was the estimate as far as that was concerned. Now, all that being said, 3.1% is almost at the lowest end of the range. And I should note the range was quite wide on this one as well. Fixed asset investment, 4.5%, so that one beating estimates. But industrial production, which, by the way, we should mention, so manufacturing was the one that really picked up the slack here.
Yeah.
Industrial production coming in at 4.5%. Also, that's almost a 2 percentage point miss when you compare that to median estimates.
So certainly the weakness in consumption is still there, right? I mean, at 3.1%, I think that's still the standout in terms of what looked the worst in this series of data. And property investment still continues to be a down arrow story. The jobless rate is still holding, I guess, still ticking lower. So at least you're seeing a little better in terms of job numbers. But residential property sales, did you mention this one?
Actually, no, sorry. We need to, let me just issue a correction for you. Can we get that other graphic back, please, as well? So March, the forecast for March is actually 6% and not 6.6, which you see on your screen. 6.6 is actually the estimate for year-to-date numbers. But still a miss, though.
Still
6%.
a miss. Still a miss.
Our apologies for that. 3.1% in fixed asset investments year-to-date. Sorry, I'm just double-checking my graphics here for you guys. 4.5%. There we go. Some strength coming through. And I guess initially you are getting an initial approval, if you will, maybe on the GDP print coming out of markets after the push weaker in the currency. We're now a little bit stronger in that.
Yep. So we're seeing maybe better data when it comes to the GDP numbers. That's why we're seeing a bit of a turnaround in the currency here this morning. Let's get a bit more analysis. Let's bring in Katya Dmitrieva, our Asia economics correspondent, on what we learned from these numbers overall. Your take.
Well, as you mentioned, the industrial side of things really helped pick up the slack. I think the consumer is still looking very weak. If you're looking at the retail, sort of the retail sales component, if you're looking at any of the other kind of home prices, real estate, the places where we really want to see a pickup in consumption, we just don't have it. As you mentioned, retail sales actual is up 3.1. We were expecting a 4.8, and even that was sort of on the weaker end. The maybe positive silver lining here is that the fixed investments are actually quite strong. So that really shows that the government support is there. Companies are spending on factories, on building out their current locations. This is a positive. And it also shows that, during the NPC this year, we heard quite a bit about further support of the economy potentially going forward. So this shows that really coming through, even when the consumer is not necessarily there quite yet.
It's, to your point, it's hard to come up with a consistent read-through here because the GDP actually beat every single forecast.
Yeah.
Yep.
But when you look at China new home sales, January to March, and property development investment, that's continuing to fall as well. Turn this Greek into English for me.
Well,
it is a big question, right? It's like, if all estimates were beat by GDP, what is actually driving that? And it looks like for now that it's really driven by industry and exports, because remember in March we had that decline in exports, that wasn't so great, but the first 2 months beat estimates and they really exceeded expectations. We're also having some strength in the US consumer. So retail sales advanced, the jobs market is incredibly strong, so that should help drive exports and manufacturing going forward as well. Really, the only thing that explains it is factory output at this point. And you can't have an economy continuing to grow strong just on one leg of the stool. You also need to have the consumer there. You need to have the real estate market there. And what these numbers underscore is that's not happening. If anything, it's being more concentrated into factories and the manufacturing sector.
Katya, thank you so much. Katya Dmitrieva breaking down that data for us as well. I want to bring in our guest now, Philipp Hildebrand. He's vice chairman at BlackRock, and he's joining us out of Singapore this morning. Philipp, it's always great to have you back here in the region. I want to get your take on China, maybe your assessment of the economy here right now. Do you get a sense, just given that first quarter GDP number of 5.3%, that we've seen the worst from this economy, and really we're seeing a pretty meaningful turnaround now?
Well, I think as your previous guest has said, there is a lack of domestic demand. That's going to be a challenge going forward. The number probably came in roughly a little bit above expectations. You can see that global activity helps in support here. The policy stance helps, but over time the challenge is going to be this domestic demand problem, and of course the fact that China is really in deflation. So these are big challenges, and then when you look further down the line, you look at population growth and so forth. You really see growth declining on a structural basis, and that's going to be a challenge going forward. So I'd say this is roughly as expected, with this big caveat around domestic demand.
Which, Philipp, David here, is, to what you alluded to, a very important part of the puzzle. China's doing well because other economies are doing well, I guess is one other way to phrase that. Philipp, what do you think is the next big move that policymakers should put in place here to address the domestic demand issue?
I think it's a tough one. There's only so much easing you can do. They have to deal with the hangover on the real estate side, as we all know. I think it's about confidence, and it's about the global environment, frankly. I mean, this is a challenge that we're all going to face, that a lot of the global developments currently make business more expensive, makes it hard to cut rates aggressively. Inflation is sticky in most of the world, different than in China, but the external environment basically is one where you're going to face challenges that you can only address up to a point with policy measures. I think this is a theme that will be pervasive throughout the global economy.
And Philipp, one last question on China, if we could, on inflation, and we've yet to see a meaningful pickup from some of these deflationary conditions that we've, I wouldn't say become accustomed to, but have been a feature of, economic reports going back about a year or so. Should markets be worried about China entering structural deflation here?
Well, I think it is in a state of deflation de facto, so it's already the case. And yes, this is a concern, undoubtedly. Now the global environment here helps a little bit in that we're seeing that inflation, although it's coming down globally, certainly on the goods inflation side, but services, of course, have proven to be very sticky. And I think what we're going to see is that, we're not going to reach the 2% globally as quickly as people thought not long ago. When you think back to Davos at the beginning of the year, people were discounting 6-7 rate cuts. That's, of course, gone now. So we are seeing a global environment that is stickier in terms of inflation. This may help the Chinese story here of domestic deflation.
Are central banks here then at the mercy of the Fed? I mean, just given what we're seeing with the strength of this dollar and a Fed that wants to cut rates but can't quite just yet, just given how strong the data has been, are we likely to see central banks here are going to have to step up and double up their efforts to really preserve their currencies in some way, Philip?
Well, central banks don't look at the currency in an isolated way. They look at overall monetary conditions, right? And so the currency movement can be helpful or not helpful in what you're targeting in terms of overall conditions. What we have seen in the case of Switzerland, I think we'll see it in the case of Europe, central banks can act independently of the Federal Reserve up to a point. And we're seeing that. We saw it in the case of Switzerland. We'll see it again, I believe, in the case of Europe. But it is also clear that the global picture, which is very much dominated by the biggest economy in the world, matters a great deal. And so I think we're going to be in a space where there's going to be some ability of central banks to act independently. The currencies will be a big part of assessing the overall monetary conditions. That's certainly true when you look at Japan at the moment. But overall, it is clear that the Fed policy path is extremely important. And that path is changing in light of fragmentation, in light of geopolitical conflicts, in light of service inflation not coming down quickly. And what we're seeing is we are essentially heading into this environment that we've talked a lot about in the past couple of months, where you have relatively sticky inflation, relatively high rates, higher rates for longer, and the central bank will find it difficult to cut rates as aggressively as people thought only a few months ago.
Philip, is that still a safe assumption you think we can make, that the Fed will cut rates this year?
Well, they want to cut rates. I would still think, 1 or 2 rate cuts certainly is possible. But we also can see that the math just doesn't add up. If you, of course, goods inflation, I continue to think will continue to fall. That will kind of lead this expectation into rate cuts. But the service inflation piece looks very, very sticky to me. And so it's going to be hard to reach the 2% target. And in a sense, you sort of face a trade-off. Either you accept that, you settle on higher inflation above target inflation, which is not something the Fed has acknowledged until now, or you end up having to do more work or having to wait longer before you can cut rates. There's no way to get around the fact that service inflation is proving to be incredibly resilient. And so it's hard to get back to the 2%, and certainly you're not going to get there if you think you can at the same time cut interest rates aggressively. And the market is coming to terms with that. It's been a longer term adjustment since the beginning of the year, and I think we're at the tail end of it. But we are. There's so many things in the global economy right now that are basically pushing costs up: fragmentation, wars. The transition to net zero, frankly, population growth, demographics, right? So many factors across the world basically lead you to a conclusion that we're going to move into a very different environment relative to the great moderation of the last few decades, where inflation is going to be stickier, rates are going to be higher on balance, and growth is going to be relatively weak.
And Philip, I mean, that's why you're in Singapore. You're attending this Ecosperity Financing Asia's Transition, or FAST conference this week as well. I mean, there seems to be so much backlash politically when it comes to ESG. I mean, what are conversations with regulators like to you now, and how does it impact BlackRock's investments into the renewable space?
I think we're focused on the transition, right? We know we need to transition. Asia has been, in many ways, very progressive on this. We know in order to do that, we need to make enormous investments in the renewable space. That is happening. That's the good news. If you look at new investments going into the energy complex, the ratio has shifted quite significantly from fossil fuel to renewable energy. You know, we believe that's going to continue to happen. Infrastructure, renewable energy infrastructure is a very big theme that we're focused on. One of the reasons we're excited about the announced acquisition of GIP. There's going to be a lot of focus on private-public schemes in order to mobilize private capital by using public capital in a smart way. Again, something that Singapore has been very focused on, something that Asia generally has been focused on. So I think the key is really, how do we create a realistic, fair and just transition to a renewable energy complex where the ratio is going to go up in terms of renewable energy relative to fossil fuel. But you cannot get there overnight. I think the world is coming to terms with that. And in a sense, what we're seeing is kind of an adjustment to what I would call a more realistic and perhaps a more pragmatic way of getting us to a new kind of architecture of the global economy that's going to take time.
Philip, a pleasure to have you on the show. It's nice to see you in the region. Of course, if you find yourself in Hong Kong at some point, do give us a ring. Let's see if we can have a conversation. Philipp Hildebrand, their vice chair at BlackRock in Singapore, live for us there. Okay, from Singapore, we'll take you straight back to Beijing. Live briefing out of economic officials. China, of course, just released about 15 minutes back a GDP print which blew through just about every single estimate out there, 5.3% growth for the first quarter.
Yep, they're taking that the foundation for the stable economy is not solid yet. That's according to the National Bureau of Statistics, adding that the external environment is complex, uncertainty is rising. We'll have plenty more analysis coming up. This is Bloomberg.
I'll mention.
All right, we'll continue to watch what goes on with these dollar moves here this morning. You're still seeing some pressure across Asia FX. Taiwan dollar dropping to the weakest since 2016 amid this dollar strength. And we're inching ever so closer to 1,400 for the yuan. It is the clear underperformer here. We're weakening by more than 1%, Dave.
Yeah, that's a problem. In fact, when you look at the Kospi index, it's also taking a very big hit. It would be, if we cross that line, would be the first time. You'd have to go all the way back to 2022, in fact, to get a yuan at this week level. Other currencies to note that are not on your screens, the Taiwan dollar has dropped to the weakest level in about 8 years, since 2016, and the Indonesian rupiah early on in that cash market coming online this hour, weakening past 16,000 against the dollar for the first time in about 3 or 4 years. So the strong dollar story is really slapping everyone inside.
Yep, and it hasn't come down to the Fed, right? New York Fed President John Williams believes that the Fed will likely start cutting rates later on this year if inflation continues to gradually ease. He also discussed resilience in consumer spending and the economy in exclusive conversation with Bloomberg TV.
The consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So yes, it's part of that story. But I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think consumers are spending.
What's the thinking in your office and among your colleagues about, does this last? Or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
That was the New York Fed President John Williams speaking exclusively with our colleague Mike McKee. We're going to get a market check coming up. Plenty more ahead. This is Bloomberg.
The U.S. and its allies are urging restraint here as Israeli officials say they have no choice but to respond to Iran's drone and missile attacks. For the latest, let's bring in Bloomberg senior editor Bill Ferries in Singapore for us. So we've now moved past the point where it's not so much if but when, but also the question on how, Bill.
Yeah, that's very much true. I mean, top Israeli defense officials saying that they will respond to this Iranian attack that was largely thwarted over the weekend. But there's going to be a big question on the timing and how they respond. An Israeli response doesn't necessarily mean missiles and jets flying towards Iranian territory. They could try to strike Iranian targets outside of Iran, and they could also use some less obvious military tools. You remember years ago, Israel was believed to be behind a cyber attack on Iranian nuclear facilities. So the nature of the response remains to be seen, but for now, Israeli officials telling their public that they will respond to that attack over the weekend.
And we've heard that the likes of President Biden, leaders in France and Germany have all in some way spoken to the Prime Minister Netanyahu. I mean, can you talk to us about some of the diplomacy at work here right now? Can some of these allies in the U.S. in particular rein in Israel to avoid a further escalation at this point?
Well, when you look throughout this process the last several months, there has been an attempt by the U.S. and its allies to change Israel's strategy on the ground in Gaza. That has had very limited effects so far, and there's opened Israel up to a lot of criticism from very close allies. That said, there's almost unanimity among Israel's allies and in the Mideast against seeing this turn into a direct Iran-Israel war that could wrap up the entire region. So there's going to be a lot of pressure coming to bear on Netanyahu and his coalition in terms of how they respond, when they respond, and kind of the nature of that response.
Bill, thank you. Bill Ferry's there, senior editor in Singapore. Let's check in on these markets here right now. You're still feeling it across stocks. You're still feeling it across Asia FX here today. The dollar strength really percolating. You can see basically it's sizable declines across the board. Taipei is certainly feeling it. We're down some 2%. We talk about these tech-heavy benchmarks. And FX, you talk about Bank of Indonesia intervening as well, just given the weakness that we're seeing in their currency and the dollar holding to those 5-month highs. This is Bloomberg.
Okay, we'll take it straight back to Beijing. Press briefing taking place amidst this release of economic numbers coming through. So monthly activity numbers, GDP print, literally a mixed bag. So activity numbers came in mostly below estimates, although the first quarter GDP numbers really coming in above estimates, in fact, beating every single forecast out there. So
yeah,
as far as that's concerned, that's taking some of the sting off the strong dollar. But it's not enough really to unwind these dollar bets coming through.
Yeah,
today.
I mean, it's a sea of red across the region here today when it comes to equity markets. The dollar strength certainly is one thing. At least you're seeing the CSI 300 doing relatively better. I mean, we're still down, but slightly down compared to the rest of the world here. But we're talking very closely the divergence that we're seeing between onshore, offshore, large cap and small caps. It's been insane as well. You take a look at that. There you go. That's where you're seeing in terms of the dollar strength. The rupiah, certainly seeing it after we did break around 16,000. You're talking about the BI saying that they had to step in to this currency as well. And overall speaking, it's just a risk-off day. Despite this better than expected headline numbers there. But the March numbers for China certainly did show still some weakness, especially when it comes to the retail sales side of things. Your Asian markets dashboard is looking like this here right now. It's 2% down for the rest of Asia. You talked about Taiwan. I believe that's the worst performance we've seen from the TAIEX. We're down the most since October, and we're down some sizable 2% or more in Taipei here. It's just bad. I mean, first it was the retail sales print in the U.S. that sent dollar flying, and this is what is the follow-through here in Asia today. U.S. futures are now punching slightly lower here this morning. Let's wait more on what's going and moving these Chinese markets and bring in our equities reporter, Charlotte Yang. She's here with us now. So even better headline numbers for GDP, not enough to really change the direction of travel here today. But what is your team watching out for the most?
Yeah, so what we've been hearing from investors that, even though the headline GDP numbers is better than expected, but they're focusing more on the weaker, what they call the weaker details, which is with retail sales as well as factory production. That's still pointing to some losing momentum heading into the second quarter. And also with broader market, we're seeing this the one corner of this market is suffering more than the others, which is the small caps onshore, which we're seeing that again tracking CSI 2000 actually fell as much as 7% at one point. And some particular selling pressure for that is not only because of small caps and this struggle with liquidity, but also that the stock regulators talked about, if you don't give enough dividends, you might be given a special treatment tax. And some worry that the small caps may be more vulnerable to be put on that, which will be bad for investors.
Yeah, speaking of bad for investors here, I'm just going to mention here, so the dollar strength, which we talked about before we brought you in, has now pushed the Korean currency beyond 1,400 for the first time going back to 2020. Let me just double check that for you, because that headline should be crossing your Bloomberg terminal anytime now. In fact, the color on that should be a bright hue of red. Charlotte, I'll bring you back in here. What do you think this drop-off in small caps indicates about the sustainability of the rally? And can we expect policymakers and the national team to come back in and stabilize these markets?
Well, our team is definitely closely watching if we get any hint of the national team, coming back to boost the market, given, small cap sell-off. That's what bringing about investors' memories, back earlier this year when they suffered the most. And that's really, going to weigh on the broader sentiment for the market. And at the moment, I think, given what we have, the broader market has already rebounded, over 10%. So investors really pausing of what they should do at the moment, given economic data is now not being that supportive negative and the sentiment is losing a bit. But we also have a Politburo meeting coming later this end of this month. So we'll be watching if we get any more, signals of support coming from that.
Charlotte, thank you so much. Charlotte Yang from our Asia Equities team here. Let's bring in Lillian Lee, Vice President and Senior Credit Officer at Moody's Ratings, joining us to talk us through the latest economic numbers out of China. Lillian, good morning, and pleasure to have you on the show. Your initial take, ma'am, on these numbers.
Yeah, we see that just the released data is 5.3%, or Q1's data is pretty delightful. But if we look into that data, we see a mixed pictures of China's economic recovery. First, the aggregate demand is actually slowly recovery. That has been reflected by the Qingmin's transportation and tourism data. Well, we see also some improvement in household income growth as well. And manufacturing is expanding, supported by policies, mainly reflected by those PMI data as well as investment data. But however, the household demand, the fundamentals seems weak, as just stated that, for example, retail sales growth and the year-on-year growth is weakening, although it's weakened from its high base from last year. And then the PMI data, the employment as well as household loan data's growth, so all these are a little bit disappointing. And property sector's data, of course, it's weakening as expected, but exports also slowed in March from its high peak in February, but that's also mainly because of base effect and the seasonal effect. The outlook of export pictures could be a little bit uncertain given the that's really much subject to growth resilience in the global market as well as geopolitical considerations. So all in all, we see some upside pressures to our own Moody's forecast this year, but the current performance as well as the policy support announced so far might suggest China may need to do a little bit more work to achieve its growth target this year. Thank you.
Okay, so you mentioned it's a mixed picture. That blowout number for first quarter GDP, though, do you think that's enough for China to reach that 5% growth target for 2024? Is it going to be a pretty easy target to reach this year, or do you think it's still going to be an uphill battle?
Yeah, as I mentioned just now, I think the government still, or the China overall economic fundamentals still need to see a little bit more upside signs to conclude that China will achieve its 5% growth. Yeah. So far, it's fundamental consumer confidence and those, for example, the large infrastructures and investment, these parts, we don't see a clear signs of upside upside trend. Yeah.
Lillian, I want to ask you about ratings. So one of your peers, Fitch, recently moved, as you probably know. Back in December, you guys moved, and you guys cut your outlook on sovereign ratings here to negative. Since that point, let's say 4 months back now, has Moody's observed any improvements? In other words, can China avoid a downgrade from you guys?
You know that we have changed outlook to negative last November. That actually reflected some of the weakness in China's economic growth as well as in its fiscal and institutional strength, mainly because of the elevated debt and the government needs to do a little bit more, spend a little bit more. So that would erode its fiscal strength, as well as the potential growth in the medium term is slowing, is trending down. So all these factors is having a negative impact on China's sovereign credit. And we'll continue to monitor it in the next 12 months. Our rating cycle is about 12 to 18 months. So during these transitions, all these economic factors and policy settings will be taken into consideration.
Right. And so can we assume then that if nothing changes within that 12-month window, you're probably going to downgrade China's ratings?
You know that I'm actually, we cannot publicly speculate this rating changes. Yeah, of course, as I said, all this progress is a dynamic progress. It all depends on the policy setting as well as the economic performances.
What do you make of, you mentioned that there's a need for more policy stimulus. I'm just wondering in terms of the fact that they've expanded that fiscal deficit budget. Is that enough for you to at least expect that the eco outlook can improve from here?
Yeah. So the fiscal impulse, we call it total fiscal expenditures from the government announced plans. It's round up about 8.3% of GDP, slightly higher than last year's fiscal spending as a percentage of GDP. So that's not really a big stimulus from our point of view. And then on the other side, the monetary policies the target is to maintain a stable liquidity environment, stable credit condition. So far we don't either see a huge amount of monetary support, and we're likely to see this monetary policy stance maintained like this throughout this year. We see a stimulus in the public sectors, in the consumer side, but largely I wouldn't expect a large stimulus coming along going forward. It's more going to be seen as fine-tuning of these policies, of these existing policy plans. So there is some gaps between its target versus the current support. It really depends on how the government is going to square those investments, square those monies across different sectors. Yeah. So which means that there will be challenges for them to achieve those targets, but it really depends on how they implement those policies.
It seems like they're throwing that money into this new slogan called New Productive Forces, which could serve as new growth drivers for this economy, whether it's EVs, clean tech, the like, Lillian. Right. I mean, how likely do you think that these pillars of the economy can be that next growth driver to offset some of the weakness that we're seeing in property?
Yeah, that's a great question. So previous China has public sector infrastructure as its own growth drivers, right? And those account for approximately half of overall GDP, and also probably more than half of the total investment. But if you compare that with the contributions with the new growth drivers, EVs, renewables, AIs, etc., currently the total contribution from this new growth driver cannot match those from the old drivers. We estimate that even for new EV itself, now it's about 2%, and then by 2030 it's going to grow up to 5% of GDP. So you see that there will be a gap of them. So that will depend on how government would provide a little bit more support to drive productivity and then increase the size of contributions of these new sectors to GDP.
Lillian, great to have you. Thanks for joining us. Lillian Lee there, Vice President and Senior Credit Officer at Moody's Ratings. We're still checking when it comes to FX here this morning. You continue to watch that strength of the dollar playing through, and you're feeling basically a broad-based sell-off here when it comes to FX. So we talked about Taiwan dollar, the weakest since 2016. Korean won, we're weakened to 1,400 or so. First time since 2022, and we're also talking about 154 handle for dollar yen, 727.16 for your offshore rate here. We have come off some of the lows for renminbi, though, after, of course, some of the numbers that we got out of that data dump as well. But the dollar still strong this morning. Plenty more ahead. This is Bloomberg.
Right, welcome back. You're watching the China Show, and so we'll take you straight back here, by the way. This is the Baidu AI Developer Conference taking place. Can't quite make out who the speaker is, but I would imagine at some point Robin Lee, if not already, has made an appearance there. Ernie Bots, if you recall, I think the latest figure here, it's now surpassed 200 million users and 85,000 enterprise clients. So one can only guess what they're talking about at this point. We'll get that to you, of course, once we have a better understanding.
And they've always been kind of the leader in this whole AI sort of story in China. Let's talk a little bit more about what Bloomberg Intelligence is expecting. They're saying that Baidu's AI-powered Ernie Bot will remain a loss-making service until 2026. Here with us now is our senior analyst, Robert Lee. Why that long? Well, we've got to wait another 2 years before it makes any money.
I think the main answer to that is competition. So obviously Baidu has some market leadership, but if you look at the latest data coming through, that is being quite rapidly eroded. which again signals or tells you that the technical barrier to entry within the chatbot and AI sector is actually quite low. So I think yourself and maybe some of your viewers remember the name Moonshot AI. This was a startup company that was invested in by Alibaba, made headlines about a month or so ago. The company's only been around for a year. It's already the #2 ranked chatbot in China. So it's come from a zero start, overtaken Alibaba, and now is #2 behind Anybot.
Wow.
And based on the latest user stats, this is on iOS data only for China, Moonshot AI had 12.6 million views on its site, whereas Baidu had 15. So the gap between them has narrowed considerably. So in such an ultra-competitive environment, sort of begs the question, is Baidu going to, turn a profit with this chatbot?
So competition apart from competition, what else are they facing in terms of challenges?
Yes, it's a universal challenge, not just for the Chinese AI companies, but there are parallels globally as well. So obviously China has a unique challenge with access to the technology that these engines run on, particularly NVIDIA chips. And with the export restrictions we've seen, that will potentially forestall the developments of the big guys, Baidu, Tencent and Alibaba going forward. But I think a more universal comment, again, applies more globally, is monetization. We've seen US companies launch various AI-enabled assistants or whatever, but the sort of level of revenue they're generating so far is relatively limited, I would say, and that's certainly true of the Chinese companies. So monetization of AI is at a very early stage, and the software companies obviously generating limited revenue at the moment, but paying out tens of billions to build the infrastructure, so they're sort of caught in the middle. Whereas the infrastructure guys, the NVIDIAs and the TSMCs of this world, are obviously doing extremely well.
So if you have to look, obviously Baidu was the first kind of early leader, but you're saying that's being eroded a little bit now by Moonshot. In terms of long-term winners in AI in China, who are they going to be now?
It's perhaps a slightly dull answer in that scale wins out ultimately, and one of the main ways that the companies are looking to monetize this technology is through their cloud business. Cloud is absolutely a scale business. The major cloud providers in China are Alibaba and Tencent, with Huawei gaining share, as I think we've talked before.
Yeah.
So I think in the long run, those companies are best placed to emerge as long-term winners. Baidu has technology leadership, but that's being eroded. So I think it's going to be challenging for them to turn a profit in the near term, and challenging them for them to maintain their lead as well.
Robert, thank you so much. Robert Lee, our Bloomberg Intelligence senior analyst from AI. Let's turn our attention to property now. And China, Vanke is said to be preparing this asset package totaling around $18 billion US dollars here to use as collateral as it seeks money from the banks. And will the banks part with that money? Loretta Chen, our bond and loan reporter, is here with us to talk us through this. It's in renminbi terms, it's 130 billion renminbi in assets. What more do we know about this?
Yeah, it sounds like a lot, but yesterday we were just talking about Vanke's liquidity problems, and that essentially stems from the declining property sales, which in March we're seeing they still going down, and there's no signs that it's going to recover anytime soon. So that money, if you think about it, really is to fill that shortfall of cash for Vanke every single month when it's generating limited sales while having to pay a lot of the constructions, having to pay back the existing debts and interest. It's never a good solution, I guess, to solve your debt problem with more debt, and I think that's the dilemma a lot of the Chinese developers are facing, right? You can try to gain more time with that property loans if you can get it, but I think in the end you still need that home sales to go up, and I think that ultimate problem still hasn't been solved.
And we're hearing about another wind-up, petition, this time with Times China. And this is, we had Shimao just a few weeks ago. What's the latest with this case?
The links with Shimao for Times China is that they're both being winded up by a bank. So previously for Shimao, it was China Construction Bank, and this time Hang Seng is filing the winding up petition. It's interesting because in the past cases, we're mostly seeing creditors or private lenders filing that winding up because they are the ones usually, are the most aggressive. They want to get recovery, and most of the loans that they're filing aren't big size. But in the case of Hang Seng this time, this is the first time I think a Hong Kong local bank is actually doing that. We're seeing more of that emerging, and I think it's a sign that banks are also getting impatient. They might have been involved in a lot of restructuring talks over the past years already, but now I think they're really stepping forward and really prioritizing that business decision over a so-called client relationships.
One last thing on China, Vanke. Okay, how do you pronounce the name? And what is the Chinese character? Just so for the record for our viewers.
The Chinese character is Vanke.
Okay, in English, how do we say it?
Yeah, we can say Vanke or Vanke.
We've been asking this in our newsroom for months now. How to say it properly.
And I can guarantee you we have yet to close that debate.
Always so many diversions in one hit.
Yeah. Anyway, you have three options. Three options to get it wrong, I guess. Loretta, thank you so much, Loretta Chen there. Setting the record somewhat straight. Plenty more ahead. This is Bloomberg. Okay, straight back to Beijing on your left. Live pictures coming through out of this should be the National Bureau of Statistics on the economic numbers, which came through. And in case you missed it, those numbers are on your right.
Yeah, and I think overall, certainly these are headline numbers that were much stronger than expected. BE has come out with their reaction to all this and saying, look, yes, serious doubts about the sustainability, just given that they think this pickup was almost entirely driven by public investment. And you're starting to see that, March, those numbers were, seemingly slow. So maybe things are already losing a bit of traction here as we enter the second quarter. You take a look at how the rest of the markets are looking like. It's pretty ugly out there if you're into risk, because we continue to see this bloodbath when it comes to equities, when it comes to Asia FX, Times China. We talked about that wind-up petition from Hang Seng Bank that was filed earlier this morning. So the property developers are certainly feeling it. KWG Group also down some 7 or 8%. There goes Shimao as well. Also, when it comes to some of these medical equipment stocks, so there was some EU trade restrictions on China that came out overnight. That was where we're seeing a lot of the weakness here today. The likes of Guangdong Biolight down close to 6.5%, of course, as the Chancellor of Germany is on his trip to Beijing and meeting with Xi Jinping, according to CCTV today as well.
Yeah. Okay. Let's pivot and have a look now at pockets of weakness amidst really what is a bigger pocket of general weakness across these markets. Global macro movers for you, and there's just about a sea of red out there, with the exception of a few like the U.S. dollar. And when you get that black tile on your screens, you know it's not ordinary day across these markets, with some sizable moves, statistical aberrations. Looking at Z-scores here, just about across the board we're down. Every single sector is down. The dollar is obviously holding up, and I think the dong is, I guess, in some ways firming up amidst really what's just broad weakness across Asian FX space. I should mention the Korean won, which crossed the 1400 level against the dollar for the first time in a couple of years.
2 years, yeah.
In 2 years. The 14-day RSI, which is a measure of momentum, is now closing in on the most, well, in the won's case, from the won's perspective, most oversold against the U.S. dollar going back to 2011. So we are nearing some of these extreme levels, not just in price, but also some indicators too.
Yep, doesn't seem there's much areas to hide in this market here this morning. I think Brent's the only sort of standout among the commodity complex here today, where you are still seeing a solid $90 when it comes to Brent crude, and we're still slightly up about 0.75%. But yeah, you talked about that blaring red. You're seeing that in Australia in terms of the ASX 200, and the Indonesia rupiah. We're weakening some 2% and well above that 16,000 level here. That's it for us here from the China Show. Bloomberg Markets Asia is next.